Good afternoon, everyone. My name is Stephen Herwire, owner of Herwire Financial Plans with Direction. Today is March 21st, 2025. Hooray, it's spring. Today, after the market roundup, we're going to talk about market turmoil. We're going to talk about a few of the statistics and how to respond. Really valuable information, and just stay tuned. Okay, watching market news. Is this a mistake? Now, one of the few original sayings from me, no one tunes into the Weather Channel to see a sunny day. Other good quotes, if it bleeds, it leads. I don't know who did that one. All investment success is plan driven. All lasting investment failure is event driven. Simply put, thank you, Nick Murray. Simply put, the news has a bias towards bad news because bad news draws more eyeballs and clicks. This justifies higher prices for ad dollars. If you ever turned on the news, they said, hey, everything's great, and then kept watching. Would you keep watching or would you simply go about your day? So, uh, when you have a financial plan, if you have a financial plan, continue to work your plan. If the news makes you sufficiently nervous, call your financial planner. If you don't have a financial plan, get one. Building your investments is only part of your financial path. The financial plan itself helps you avoid or mitigate potholes in the road along the way. Financial planner can be the voice of reason, offering perspective you might not think of. I recently had a phone call with a client who was starting to panic because she'd been watching the news. I calmed her down, reminding them that the market downdrafts were common and that after I'd looked at their plan, I explained that based on the information in the plan, there was a low probability they would run out of money before they ran out of life. Now, thank you to the folks at JP Morgan. This is from their guide to the market. This is what many advisors call the measles chart. Now, if you've never seen the measles, you won't understand that reference, but measles, you get a bunch of red dots all over you. The red dots here are the lowest point the stock market, as represented by the S&P 500, were during any given year going back to 1980. And despite the average intra-year drops of 14.1%, the annual returns were positive 34 out of 45 years. So that's a little bit better than 75% getting ahead. In 1987, for people who were around and paying attention back then, there was an event called Black Monday. The stock market dropped 20% in a single day. Now, had you put your money in the market at the beginning of 1987 when Black Monday happened, in the S&P 500 specifically, and sat on your hands and did nothing for the entire year, you actually were 2% up for the year. So people sometimes they want to avoid these ups and downs, and you really can't. They say, what's the best sector to invest in? The answer is always the same. It depends. As you can see from this chart, it changes from year to year, and nobody knows in advance which sector will be best. In the opinion of some, putting together an allocation would be a best path long-term adjusted for your particular risk tolerance. Most of the time, this strategy will not beat the best sector, nor will it be as bad as the worst sector. Okay, another question I sometimes get is when should I invest? Should I wait for a pullback? Well, this chart goes back to 1950. It shows all the intraday highs. Matter of fact, since the beginning of 2024, there have been about 60 all-time highs. And how do you know if it's an all-time high? It's like, well, if the market closes and the market's never closed this high before, that's an all-time high. So in the short term, if you invest in a day that's an all-time high in 3 months, your average rate of return is about 2.4% for that 3 months. If you invest on any given day, the average is about 3.0. And if you go out to 5 years, any day, investing in any day, your return's about 74.7%. And if you invest in an all-time high, it's 80.9%. So getting back to when should I invest? Well, there's an old saying. The best time to invest was 20 years ago. The second best time is today. And keep in mind, this is really important. It is not timing the market, it is time in the market. Nobody, the facts about the future are not known, and so nobody can predict the future. So, time is the important factor here. This is a chart of investing in the S&P 500, investing in a bond portfolio, or what's called a 60-40 portfolio, which is 60% stocks, 40% bonds. Going back to 1950, the worst performance of S&P 500 is down 37%. Best performance is up 52%. For the bond portfolio, it's down 13% to up 33%. And if you did the 60-40, it's anywhere from minus 20 to plus 34%. So key thing here is any money that you know you're going to need, like a house down payment or buying a car, you don't put in the market because there's no way to tell where the market's going to be a year from now. Now, when we get out to 20 years, which is a decent representation of how long people are retired, 100% stock portfolio, as referenced by the S&P 500. If you pick the worst 20-year rolling period going back to 1950, you made 6% a year. If you pick the best one, you made 18% per year. So it's and all points in between. On the other hand, if you went to the quote unquote safe bonds, you could have ended up in 20 years making 1% a year for 20 years, which won't keep up with inflation. You could do as well as 11%, but why take your chances? And then if you did a 60-40 portfolio, anywhere from 5 to 15%. So one of the important things I told you that I was going to tell you is how to respond to all this market turmoil. I'm going to quote the 46th President of the United States in one word: don't. Keep your head down, work your plan. That's why you have a financial advisor. They'll bring perspective that might not occur to you. They'll help you stay focused on your goals. They will analyze and recommend adjustments to your plan if warranted. If you don't have a plan, they'll build a plan for your unique situation. If they spot potential potholes in your path, they will suggest ways to mitigate or avoid them. They'll help you optimize Social Security and pension benefits. In some cases, they'll do tax planning. Now, keep in mind, when I say tax planning, I do not mean tax advice or tax preparation, because they're two different things. Tax planning is where the financial advisor who knows your big picture will suggest things to whoever's preparing your taxes and see what they think about it. Because in the final, in the end, it's important to get tax advice from people that are qualified to give advice specifically on taxes. So once you graduate, be it from welding school, engineering school, or law school, you're going to need a different plan for each of these stages that's tailored to your specific situation. In your working years, generally speaking, the most important question is, am I saving enough and is it in the right place? Once you get in the glide path to retirement, which is in my definition, the last 10 years prior to retirement, will the USS retirement be ship-shape on the appointed day? You're going to have to ask questions like, how do I take my pension? If I have one, what's the best way to take Social Security? So on and so forth. Once you get into retirement, the big important thing is, how do I avoid running out of money before I run out of life? And finally, legacy. Does what I worked hard for get to where I want it to after I'm done with retirement? I can be reached at herwirefinancial.com. I do in-person Zoom and phone appointments. I am licensed and registered across several states and can easily add states if there's a need. If you'd like to schedule an appointment, click on the Schedule an Appointment button in the upper right-hand corner of my website. You can like and follow me on Facebook, LinkedIn, Twitter. I have a YouTube channel. It's that red button, 2 buttons over from the Schedule Appointment. That's where videos like this eventually end up. And for those who prefer the good old-fashioned telephone, my phone number is 518-631-2569. Do not text that number. We'll both be sad because the text won't reach me. There's a separate texting number right there. Opinions voiced in this material are for general information only, not intended to provide specific advice or recommendations for any individual. All performance references historical, no guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax, legal, or ERISA or investment advice. Consult your advisor prior to taking any action. Unmanaged index returns do not reflect fees, expenses, or sales charges. Index performance is not indicative of the performance of any investment. Investing in stock includes numerous specific risks, including fluctuation of the dividend, loss of principal, potential illiquidity of the investments in a falling market. Investing in mutual funds involve risk, including possible loss of principal. Fund value will fluctuate with market conditions and it may not achieve its investment objective. The Dow Jones Industrial Average is comprised of 30 stocks that are major factors in their industry and widely held by individuals and institutional investors. The Standard & Poor's 500 index is a cap-weighted index of 500 stocks designed to measure the performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. The NASDAQ Composite Index measures all NASDAQ domestic and non-US based common stocks listed on the NASDAQ stock market. The market value, the last sale price multiplied by total shares outstanding, is calculated throughout the trading day and is related to the total value of the index. Everybody have a terrific weekend, and we'll see you next week.